Welcome traders back to another lesson here on non-compounded investing. What does this mean? Well, firstly, number one, you've probably heard the term compounded interest. So compounding interest is where a trader invests his profits every single month back into the market. Non-compounding investing is where a trader takes his profits every single month and doesn't reinvest his profits. Now, you might think that you could get a much higher return by reinvesting your profits. Yes, you can. But with traders with smaller trading accounts, it's better to take your profits because it's safer to do that. And I'm going to show you exactly what that means inside this demonstration today. So let's go take a look right here. So the statement non-compounding investing is safer is demonstrated in this example. Now let's take an example. If you're risking 50% of your trading account, we're talking about traders that's got small trading accounts that are trying to get the maximum out of their trading account. And I'm also talking about traders that don't have additional capital, which means they're trading the max you can out of that account and you don't have additional capital funded. Okay? If that is the case, then this is the situation you need to know. When we're looking at a scenario where we have 50% of risk on your portfolio and you're risking 50% every single month on whatever your balance is, if you're using compounding interest, which means you're compounding all your profits and you're trading your profits every single month, you'll notice that in this example, it'll take you up to the month 9 before you actually see a surplus. Now, with a surplus, I mean is that if you had to take your balance in month 9 and you divide that by 2, which means you lose 50% of that, you'll be left with $10,717. And left with $10,700 would mean that you are actually only $700 in profit after month 9. Now, if we continue in months 10, 11, and 12 making profits, then by month 13, if you take your $31,000 that you've made with compounding interest and you then lose 50% of your capital, you'll notice you'll be left with $15,600, which means that it's only $5,600 more than your initial investment. And that is a 50% growth. Now, that is compounding interest, right? You trading your profits every single month. Now, let's take a look over here. This is non-compounding investing, and this is why we say it is safer. Because if you look over here, if your initial investment is $10,000, and every month you take in your profits, and we're using the example like we did in the previous example of 10%, and if you're making a 10% growth, and you're taking those profits and you bank in it, and you want to cover your actual drawdown, which is 50%, by month 5, you have covered your drawdown. So where the other option was month 9, you'd be in a surplus. Right now, in month 5, this is where you cover your drawdown. And thereafter, you're making profits. And if you went all the way up until month 13, and month 13, you lost 50% of your initial drawdown. All right, 50% of your initial drawdown. What are we looking at right here? Well, your initial drawdown would be 50% of $10,000, right? Because you're taking your profits every single month. So if you keep taking your profits every month and you lose in month 13, you lose $5,000, which is 50% of your initial investment. That means that you will be left with $17,000. And that is 70% growth from your initial investment. So not only does non-compounding investing is safer, but it also is more profitable over the long term if you do get a 50% drawdown, because you're only risking on your initial investment and not on all your capital, including your profits in that setup. And this is why what traders should consider is working on this structure with a low or a smaller trading account. Go ahead and the first few months bank your profits so that you can use those profits to protect your initial drawdown. So if you ever come into a situation where you want to go ahead and call it a day, you can do that with the profits and still be able to continue, which means that you just reset and you start all over again. So using this example right here will certainly help traders to be able to build their portfolio up without risking their whole portfolio. Because keep it in mind, if you're making a 10% return every single month, then that means that in month 1 you've made 10%, which means that your total risk is only 40% because you've made 10% already. Then month 2 you've made another 10%, that means your total risk is only 30% because you've made 20% profit, and so forth and so forth. So which means by month 5 you've managed to profit 50% of your portfolio, which means that 50% is your drawdown, so that if you ever want to call it a day, you have that capital available, and the rest of the year is all net profit. And so that's a good way to be able to do that. Now, in summary, when using a more aggressive trading approach to gain as much as possible out of the market with the funds that you have available, it is always good practice to find a way to protect your funds as fast as possible. In the examples that I've shown you and provided you, you will see that the non-compounding investing method can protect your funds quicker and give you a better return in the long run when things don't go well and you hit your max risk limit. Traders, we're going to talk about how you can also use different currency pairs, and reduce your margins, especially those that have higher or at least lower leveraging from the broker. Maybe they're trading with a 50-to-1 leverage. Maybe they're trading with a 30-to-1 leverage. How can you reduce your margins by reducing the currency pairs that you trade? We'll talk about that in the next lesson.